Hello, I'm Soleil Valiappan. I'm an angel investor and venture capital investor based in Sydney. Today, I'm going to be sharing about the dilution impact of when you raise a capital round. Let's first start with some definitions. There are some technical terms that get thrown around, so let's ensure that you understand what they mean and the context in which they are used. The first one we have here is a cap table. So, this is a table, or generally a spreadsheet, that shows the ownership structure. So, it should show who owns what percentage and what type of security. An example of this is maybe someone has ordinary shares and maybe someone has preference shares. We're not going to talk about that in this presentation, but I just wanted to share that as an example. The valuation. So, this is the estimated worth of a startup or a growth company. And then you may hear the technical term of a pre money valuation. This is the estimated worth of a startup before you take on investment. And then you have a round, which is a discrete fundraising event when a company raises capital from investors. So you might hear this in a sentence of, we are raising a round, or this is happening in the next round. That's how you might hear it. Then we have a post money valuation. So, this is the estimated worth of a startup after investment. So, you have the pre money, you raise a round of capital, and then you can calculate your post money valuation. Then we have dilution, which is a reduction in ownership percentage for existing shareholders when you raise a round of capital, and that means that you're issuing new shares. And usually this occurs in a fundraising round. So we're using quite a few terms here. And then lastly, we have ESOP, which stands for Employee Stock Option Plan. So this is a pool of the company shares that are reserved for employees, and it's a way to incentivize them as equity compensation. Sometimes an operator is coming to work for you at a startup, and then you're not going to be able to offer them the same salary as if they were out in corporate. This could be a way to sweeten the deal, but also to help them to come on board for a long term and help create value and build the company for the long term. So, here are all the definitions in this presentation that are useful to know. We're going to work through a very simple priced round example. This is so that we can see the calculations really easily. It can be complicated when you're looking at instruments such as a safe or convertible note. So, in this presentation, we're going to look at a simple priced round where you sell your shares in a company and in exchange, and an investor receives equity. The example we're going to look at here is, I want to raise $1 million of investment and with a pre money of $4 million. So remember, the pre money valuation is what the company is worth before we raise a round of capital. And there are many ways to calculate this. At the early stages, I would say this is both an art and a science, and this figure can be based on a number of factors. I'm not going to go into that in detail. I can do another video on that another time. But at this example, we're just saying the pre money is $4 million and that we want to raise $1 million of investment. And because this is a simple price round, this means that after the raise, the post money valuation will be $5 million. Now we're going to calculate the dilution impact of this simple priced round. We know the pre-money valuation of 4 million. We know the investment amount of 1 million. So we can calculate the dilution impact because we have the post-money. So to calculate this, we take the investment amount and we divide it by the post-money valuation. So this tells us that the dilution impact to existing investors who were invested at the pre-money valuation level will be 20%. But let's have a look at this graphically. So it's the same thing, but we're just going to look at it in a graph. In this example, we're saying that the founders have 100% of the shares before investment. So the pre-money in this state is $4 million. Then, after the $1 million of investments for which we've created new shares, the investors now have 20% of the companies and the founders now have 80% of the company. But overall, the company is now worth $5 million. So this is the same calculation, but I'm just showing it in graphical form. This is an illustrative cap table, or graphic of a cap table, I should say, which shows ownership over time. So the dark pink is the founders and what percentage they have. So at the inception here of the company, we're saying that the founders have 100%, and that it dilutes over time. So as you create employee share option pools, that's the very light pink at the top, and also as you take on investment rounds as well. And the investors coming in, I've put them as the light pink. And remember that as a founder, although the percentage of your ownership will reduce over time, the idea, the hope, and the idea is that the valuation of the company is growing significantly each time you raise. And remember, if you are building a venture capital backed company, you are likely going to be raising capital every 18 to 24 months to continue to fuel the ambition of this growth. Now, let's look at a few things to note. One of them is the dilution, like aiming for a target range of 10 to 25%. This is a rule of thumb and it depends on the stage, the industry, the sector, your traction, what is happening in the market. But with this guideline, you can scenario test what a good min or max valuation levels could be. It can also help you determine whether it's worth you raising a round of capital or not. The next is ESOP, so targeting a range of 10 to 20% overall. Remember, this can be built and topped up over time, and it's a great way to incentivize talent to come and work with you. Then next we have future rounds. Remember, whatever happens early on can have an impact on you in the future. Say, for example, you raise at a really high valuation that you don't grow into in the next round, or perhaps at the next round, it ends up being a down round, which is a round that is lower than your previous round. That's often, yeah, sometimes it's not a good look. Another example is if you do dilute, I should say, too much of your position as a founder early on. You may then jeopardize being investable in the future, and this is because you don't have enough ownership to stay in for the long run. And in the early stages, it's all about the founder and their ability to execute. So, here are just a few rules of thumb. They're not hard and fast rules, but just things to keep in mind when you're constructing and negotiating your round. Now, let's revisit the priced example, but let's have a range of pre money valuation figures. So, here we've got a range of pre money valuation figures from $1 million all the way up to $20 million. And we're going to calculate what the post-money valuation will look like for each of these figures. So at the 1 million pre-money with an investment amount of 1 million, we've got a post-money of 2 million. We're keeping the investment amount the same across all of these pre-money scenarios. And then on the other end, we've got the $20 million pre-money. And with $1 million of investment, we get $21 million of a post-money valuation. So then we can easily calculate the dilution impact, which is the investment amount divided by the post-money valuation. So at the 1 million pre-money, the dilution is 50%. And then at the other end, at the 20 million pre-money, the dilution is 5%. I've rounded up these percentage figures as well. So, the rule of thumb that we were looking at the things to note of being between 10 to 25%. So, if an investor gives you a term sheet with a pre money of $1 million, and you're raising $1 million, then you know that dilution will be 50%, which I'd say is on the higher side, especially if you're building a venture backed SaaS company. And then on the other end, if you have $20 million of a pre money and you're only being diluted by about 5%, I'd say this is more of a rare case, but would be a great deal. But if you are valued or if your company is at a much higher amount, then you can potentially raise a higher amount as well. And this is to then put fuel to your ambition growth plans. Before, when I was talking about scenario testing the min and max, this is the way you can do it. And remember, it's up to you if you want to accept a deal. Just ensure that you have all the information and that you understand the terms of what you are signing up for. Here, I've put 25% as orange. It's still, of course, within that 10 to 25%, but I'd still say it's on the higher side. Typically, you would see a range of 10 to 20% dilution. So let's look at a graphical representation of all of these scenarios. So for each of the pre-money valuation scenarios here, we're graphically showing what percentage of the company founders will have after the round. We are assuming in this scenario that founders had 100% of the company before this capital round. So here we can see again the pre-money valuation of 1 mil. If we're raising $1 million, then you'll be diluted by about 50%. And then on the other end, with the 20 million pre-money, if you're raising $1 million, the dilution is 5%. So that's the light. The light pink is when the investors are coming in. So let's do a very brief recap. I like to think of calculating the dilution impact as 3 sides of a triangle. You need to know at least 2 of the sides to be able to calculate the third. So if you know the pre-money and the investment amount, then you can work out what the post-money valuation is, and then you can do the dilution impact calculation. So once you know all these figures, then you can calculate this. So the investment amount divided by your post-money valuation gets you your dilution impact, and this will significantly help you to understand the terms of the deal and what it could mean for you as a founder. So there you have it, a brief explanation of some technical terms and how the dilution impact works for capital rounds. The examples that I provided here are straightforward, simple priced rounds, but I'll probably be doing some safe examples in the future of what it looks like impact wise. There are a couple more steps that need to be considered. So leave a comment if there are any other terms or concepts that you want to learn more about.